What if the biggest threat to global markets right now isn't inflation, not interest rates, and not even a recession? What if the real danger is a geopolitical domino that could send shockwaves through oil markets, currencies, and stock exchanges across the world? Because right now something unusual is happening. Investors from New York to London, from Tokyo to Dubai, are quietly watching the same flashpoint: Iran. Every headline about rising tensions in the Middle East is triggering small tremors in global markets. Oil prices jump. Safe haven assets surge. Stock markets hesitate. But here's the real mystery. Why do markets panic so quickly when Iran is involved? And why have some of the biggest financial shocks in modern history started with geopolitical conflicts in this exact region? Welcome to its financial history too. To understand why investors are suddenly nervous again, we need to go back because the story of Iran and global markets didn't start this year. It began decades ago, and every chapter follows the same dangerous pattern. A pattern markets know very well. The origins of this story trace back to one simple fact. The Middle East sits on the world's most important energy supply. Roughly a fifth of global oil passes through a narrow maritime corridor called the Strait of Hormuz. Tankers carrying millions of barrels move through this channel every single day, and Iran sits directly beside it. That geography alone gives Tehran enormous strategic leverage over global energy markets. Whenever tensions rise, investors immediately start asking a terrifying question. What if that route is disrupted? Because if the Strait of Hormuz were ever blocked even briefly, the global oil supply could shrink overnight, and when oil supply falls, prices don't rise slowly. They explode. History has shown this again and again. The first major example came during the 1970s oil crisis. Political turmoil in the region triggered supply shocks that sent oil prices soaring and pushed many Western economies into recession. Inflation surged, stock markets crashed. Energy became a geopolitical weapon. The world learned a painful lesson. Events in the Middle East can move the entire global economy. Fast forward to the 2000s and the pattern continued. Every time tensions rose between Iran and Western powers over nuclear programs or military actions, markets reacted instantly. Oil traders, hedge funds, and central banks began pricing in the risk of disruption. Even rumors of conflict could move billions of dollars within hours. But the real turning point came in recent years, when tensions began rising again at a dangerous pace. Sanctions, cyber conflicts, proxy wars, and regional power struggles created a volatile environment where one small spark could trigger a larger fire. And that brings us to the current moment. Because what investors are seeing today isn't just another political dispute. They're seeing a chain reaction forming. Every new incident, whether it's military activity, diplomatic breakdowns, or regional clashes, adds another layer of uncertainty. Markets hate uncertainty more than anything else. When investors cannot predict the future, they start protecting themselves. They sell risky assets. They buy gold. They move money into the US dollar, and they bet that oil prices will rise. That's exactly what we're starting to see now. Energy markets have become increasingly sensitive to any news involving Iran. Even minor developments are enough to cause price swings. But oil isn't the only thing reacting. Stock markets across the world are also feeling the pressure. Large institutional investors, pension funds, hedge funds, and sovereign wealth funds are constantly adjusting their risk exposure. If geopolitical tension grows, they shift capital towards safer sectors. That's why defense companies often rise during global conflict fears, while airlines, tourism, and manufacturing stocks fall. Energy prices also feed directly into inflation. If oil becomes expensive, transportation costs increase. Food prices rise. Manufacturing becomes more expensive. And suddenly central banks face a nightmare scenario. Inflation rising again just as they were trying to control it. This is why financial markets react so strongly to Middle East tensions. Because energy isn't just another commodity. It's the foundation of the global economy. But here's where the story takes an even more surprising twist. Despite decades of crises, the world still depends heavily on the same energy routes and the same fragile geopolitical balance. In other words, the system never truly fixed the vulnerability. Instead, markets simply learn to live with the risk, and every few years, the same pattern returns. A political escalation, rising tensions, investor panic, oil price spikes, economic uncertainty. We've seen this cycle during the Gulf Wars. We saw it during sanctions crises. And now we're seeing early signs of it again. But what makes this moment particularly dangerous is the global economic environment. The world is already dealing with high debt levels, fragile supply chains, and economic slowdown fears. Adding a major geopolitical shock on top of that could amplify financial stress across multiple sectors. In fact, some analysts warn that a serious disruption in Middle Eastern energy supply could push oil prices dramatically higher within weeks. That would ripple through global economies. Emerging markets that rely heavily on energy imports could face currency collapses. European economies already dealing with energy insecurity could experience new inflation spikes. And stock markets, already sensitive to interest rates, could face sudden volatility. This is why investors are paying attention now. Not because a crisis has already happened, but because history shows how quickly things can escalate. And the market remembers every previous shock. But here's the part many people overlook. Sometimes the biggest market movements don't happen during wars. They happen during uncertainty before the war. When investors cannot calculate risk, they often overreact. Capital flows move suddenly, volatility spikes, entire sectors swing dramatically. In many cases, the financial damage begins long before the first shot is fired. And that's why analysts are watching the Iran situation so closely today. Because if tensions continue rising, markets could begin pricing in worst-case scenarios. And once markets begin expecting chaos, reversing that psychology becomes extremely difficult. Governments and institutions have tried many times to calm markets during geopolitical crises. Diplomatic negotiations, strategic oil reserves, economic sanctions. But these fixes often provide only temporary relief. Because the underlying issue remains unresolved, the global economy still depends heavily on politically sensitive energy regions. That structural vulnerability has never fully disappeared. And as the world transitions slowly toward renewable energy, the risk may persist for years. So where does that leave investors today? There are three major lessons that history keeps repeating. First, geopolitical risk can move markets faster than economic data. A single political event can trigger billions of dollars in market shifts overnight. Second, energy remains one of the most powerful forces in global finance. Any threat to oil supply instantly affects inflation, currencies, and stock markets. Third, uncertainty itself can be more dangerous than conflict. Markets react not only to what happens, but to what might happen, and right now that uncertainty is growing. Whether tensions escalate or cool down, global investors are watching carefully. Because the next major market shock may not come from interest rates or economic reports. It might come from a narrow waterway, a geopolitical rivalry, and a fragile balance that the world has depended on for decades. The question is not whether markets will react. The question is how big the reaction will be if the situation spirals further. And history suggests that when energy, geopolitics, and financial markets collide, the ripple effects rarely stay contained. If you found this analysis helpful and want more deep dives into global finance, geopolitics, and the hidden forces shaping markets, make sure to subscribe and stay tuned for the next video.